my bills. I get my back into my I don't need to fight to prove I'm right. I don't need to be forgiven. Good morning, everybody. Happy Monday. It's December 19th, 2022. Great to be with all of you today. Time for a daily bite. So we have another daily bites coming up before the holidays. We'll be off next Monday, of course, for markets are closed for the Christmas holiday. We'll be back on Thursday with a preview, hopefully, for New Year's. And then we won't be back on the 2nd. That's also a market holiday. Markets will be closed. So we'll be back. Maybe I'll do one on Tuesday. I'm not sure yet when we come back first of the year. But just a couple more left daily bites before 2022 is over. So it's great to be with all of you today. If you don't know who I am, my name is Bob Lang, and I run explosiveoptions.net along with the chat room, amazing chat room here. You can see that right here with some incredible people, incredible traders, and in fact, two of them are in the house with me today. Of course, many of you know Leanne, but also Sam DeMarco, who has been with us for a very long time, an excellent trader in his own right. He's spending a couple of days with us as well, too. So welcome, Sam. And let's talk a little bit about the markets here because we have a lot of stuff to cover here. So as you can see, the futures are off their highs from early in the morning. We're up about a point or so on the S&P 500. The NASDAQ up about 10. The Dow is down a little bit here. It did close below fair value, or above fair value, actually. So the Dow is actually would open up down about 30 points, not 10 or 11. Let's talk about the action last week and some things that we could be looking forward to this week. So just as a reminder of a couple of things. First of all, I have a webinar later on tonight, 8 o'clock. I'm going to put the link into our chat room, and you'll see some of those out there on Twitter and social media as well too, talking about options done differently. I'm working together with a very, very popular team and lady who does some amazing work, Michelle Schneider. Some of you know her from Market Gauge. So we're working together on some stuff, and we're going to do a webinar today. You're all invited. It's free, and hopefully you'll get to learn a lot about it. It's a little bit more about basics on options, but if you're looking for that, this is a place to go tonight to watch that, 8 o'clock Eastern time. And then another reminder, I've been hearing a lot of people wondering about the Santa Claus rally, right? What is the Santa Claus rally? When is it? Has it happened already, or should it have happened already? So basically, some years ago, Yale Hirsch, who is the curator and started the Stock Traders Almanac, his son Jeff, a good friend of mine, Jeff Hirsch. So Yale Hirsch came out and did some work and did some studying about timeframes and periods and calendar anecdotes, and he noticed that there's a time frame around towards the end of the year, which kind of encompasses the last part of December into the first part of the year. And it kind of sets up generally for how the markets are going to do going forward into January, first 5 days of January, and then the whole month of January, and then possibly how that momentum will push into the end of the year. So the Santa Claus rally period is a 7-day trading period. It encompasses the last 5 trading days of the year and the first 2 trading days of the new year. So if we look at the calendar, what are the last 5 trading days of the year? It actually starts this Friday, December 23rd, okay? December 26th, the markets are closed, so 23rd is the first day. 27th would be the second day, that's Tuesday. 28th, Wednesday. 29th, Thursday, and 30th on Friday. So that's the last 5 trading days of the year, Okay, next year we'll start trading in on January 3rd because January 2nd is a holiday for New Year's. So January 3rd, January 4th. So this time frame covers December 23rd, this Friday, through January 4th. And this 7-day trading period, there is no magic, there is no formula for when the markets are going to go up. But we've had a couple of years prior when the markets got slammed the first 4 or 5 days and really made it up the last 2 or 3 days. We've had the opposite happen. Markets really went up a lot in the beginning and got hammered later on. So generally speaking, why is this important? It's important because a lot of people follow it, right? I'm not a big fan of calendar anecdotes, but there are people who follow it, and people, big money, sometimes big money follows these things too. So we have to be aware, and we have to be aware that these things can occur on a regular basis. But trying to make bets on or make trades or plays on the calendar is really a dicey situation. I prefer to use the charts and let them tell me what to do. So as we talk about the charts, let's go to the charts. And so I want to show a couple of charts for you here. So first of all, let's talk about the S&P 500. Let's go to this one here. And the thing I want to isolate in on here is the fact that that 200-day moving average has been ideal for rejecting markets, right? And you might say to yourself, well, over here we got 3 closes over that market. Okay, yeah, that's fine. But you know what? We've been in a bear market. The 200-day moving average is bending down. I'm not changing the rules or anything like that, but I'm just making observations, right? If we got a definitive move over that 200-day moving average back in the early part of December, I'm willing to give the benefit of the doubt to the bulls, but I can't do that yet. And look what happened last week. We had a big shot up towards 4,100. Now, if anybody doesn't see how 4,100 is significant resistance where a lot of people are selling, I don't know what you're looking at. You need a new pair of glasses. Okay, look at that, right? We tagged it in early December, failed. We made a higher low, but then we tagged it on Tuesday on that CPI day and failed miserably and closed below that low that was created over here. So this is, I even said on Twitter, even in the chat room, that the Tuesday's candle right here, okay, was one of the most bearish candles I've ever seen. Okay, this thing right there, this thing with we opened up high, we rallied up and then came all the way down over here, touched that 20-day moving average and closed miserably. And then we followed through with a lower high and lower low the following day. So, and that was Fed day. And then, of course, Thursday and Friday were down sessions as well too. So we can see that the relative strength is starting to falter here. MACD actually went on a sell signal just before, just after we tagged that 4,100 level the first time around. I can't get too bullish over here, right? As we come up into the Santa Claus rally period, I can't get too bullish. Are we going to have up days? Of course we are, right? Let's look at the oscillators here for a minute. So you go back over here, and you can see the oscillators are mildly oversold here. Minus 158 on the NICE and minus 166 on the NASDAQ, all right? We could certainly rally up a little bit from there as we did back in October, early part of October, and rally back up over here. I don't think we're going to head up over here, but still, it's a series of lower highs, lower lows, even on these charts. It's not bullish at all, right? So what are we looking for? I think these last 9 trading days of the year, we have only 9 trading days left. These last 9 trading days, we're going to look for a lot of positioning going on. I think today and tomorrow are a bit of overflow from what happened in from expiration week of last Friday. A lot of options expired, so a lot of people might have been given stock unbeknownst to them over the weekend, and they got to sell the stock. So that's why we're going to see a lot of lower prices on some things, and then maybe they bounce back after they get sold. We do see volatility starting to climb a little bit here as well. One more chart I want to show you here. This is one I share a lot, is the stocks, S&P 500 stocks above their 50-day moving average, right? And what do I like to do? I always like to put a box around below 50%, right? And I've always said that if we get back into the box, it's no good. What do I say? No bueno, right? No good back in the box. So we had a little bit of time here back in the summer, July and August, where we floated above there, reached 92%. That was after coming off of a 2%. So if you average those two out, that's about 45, 50%. So the stocks above 50-day moving average like to be around this 50 to 55% area, right? They like to meander around there. But when we break through into that box, we can see on several different occasions, it hasn't been good, right? In fact, we saw back in August, this thing fell through. We tried to rally back in September. It fell really hard here in a very short period of time. Go back to May and June, we couldn't even barely get above the box. And when we plunged in June, and then go back into the spring when all this volatility really started to come to a head, we plunged down over here into the 20-25% range. So could we get back down over here into the single digits? Absolutely, right? And if we follow through here into this box with negative divergences that I've been seeing everywhere on the charts, this is just one more clue, one more indicator that says that we have more downside over here. I'm not much into predictions. I don't really, I mean, the predictions, everybody's got them. But if you were going to pin me down and say, hey, Bob, where do you think the market's going to end in 2022? I would say given the evidence and given the heaviness of the markets right now, I would say somewhere between 3,700 and 3,750, probably more specifically 3,700 to 3,725 on the S&P 500, because we do have a big gap that needs to get filled. I can show you where that is here. This gap here from November 9th, right? So this was the close on November 9th. It's about 37.48 on the S&P 500. We know often that gaps get filled. Now, this is not, I had to correct somebody over the weekend on Twitter that this is not the gap right here. The gap starts here. It's from the close to the next open, right? So here's the close here. Here's the open there. We closed up there, right? So to fill that gap, you got to get down to 37.48 on the S&P 500. Okay, so we can see that the path of the S&P 500 is heading down there. So what do? You have puts on, you have protection on, right? And you take advantage of up days to put that protection in your portfolio. Okay. Again, I'm just using the charts. I'm using the technicals. I'm using what I see happening here. I'm not listening to other people. I'm not listening to influences. You shouldn't be listening to other people who give their opinions based on some wild information that they get out there. What you should be doing is paying attention to what I'm doing, looking at the charts, seeing the trend, and you either buy into it or you don't, right? Either buy into it or you don't. And I've been a chartist or technical analyst for a long, long time, and I've seen these patterns repeat themselves over and over and over again. All right. So I'm looking for that gap to fill. There's another gap down over here, of course. I want to say it's closer to 35.80, 35.70. You can see that right here, right? I mean, this gap was never filled. This was a down open or down up open, down close around 35.80 on the daily chart here, right? And we gapped up the next day and we never came back and filled that. So there's more downside there to be had. Perhaps I can't see this happening to the end of the year. Anything is possible, of course, but that would be quite a move. Another 10% down. The S&P 500 is already down almost 5% in the month of December. By the way, did you know that the S&P 500 is almost down 20% in 2022? The Nasdaq down 31% so far. Nobody's talking about that, right? Nobody's other than me. And you can see that it's going to be a miserable finish for the year. And I think when people see that and they hear that going on, they're just going to say, look, you know what, I'm out, I'm done. Is that the right thing to do? I don't know. Most cases, you don't sell when the markets are down. But you know what, we're not in a situation some of us are familiar with. We're in a situation with higher interest rates. We have high inflation, and we have a Fed that is doing its best to fight those things. And as a consequence, it makes the equity markets much less desirable and much riskier going forward. So I think it's going to be it. And I appreciate everybody spending a little bit of time. I want to, if you're not here on Thursday of next week, please have a wonderful holiday. Have a Merry Christmas, and I thank everybody for listening in on the Daily Bites and being in the chat room. And we'll be back on Thursday, probably with a little holiday tune. But I hope everybody enjoyed Bob O'Reilly. And again, Sam's here with us, and he's going to be sharing some stuff with us in the chat room a little bit later on today. Have a great day, everyone, and I'll see you back on Thursday.
The Exodus is here.